right corner. So point in the top right corner and pin my video, and then you'll be able to see everything. Hi. So that's the first thing. So just get that in. I've also got the Q&A open. I've got the chat open. I love questions and like stop me, ask questions. Let's get some clarification going. We want to make this as interactive as possible. So if you have questions or you want to ask something, please don't hesitate to do that. So I hope that's all good. If you have, like I said, I am watching. If you need stuff, just ping me. Feel free to raise your hand as well. You can jump on the video, ask a question. So the more interactive we can make this, the better. The less it's me just randomly speaking to myself, the easier this gets. So there's a Q&A section as well as the chat. And don't forget to pin the video. And talking about like what I'm going to be chatting about today is this graph over here, and it's a huge drop-off between early stage investments, and this is from the Brighter Bridges report in 2022, looking at African investments, and there are way more very early stage investments, and you get a huge drop-off in the number of successful investments, typically around the Series A, Series B side, but it drops off quite heavily. Just between seed and Series A, there's normally only 30% of the companies that have raised the seed round go on to raise a Series A. And this is looking at Africa and African data. And so when we look at that, it's like you have to wonder, like, why is that? Like, why are there not the same number of startups getting funded, or why is there such a massive drop-off? And normally around this point, around the point of Series A, there's you're no longer investing in hype or potential. You're no longer sort of gambling on what this might be. But it's where the rubber really hits the road, where there's normally enough evidence to see in a much more tangible way what is the trajectory of this business. And the bottom line is 60% of businesses, or over 60% of businesses, never make it across that hurdle. They can't show the evidence. They can often raise on hype and win some competitions and win some early funding. But there's this huge drop-off when they have to show that this can be a viable business and how big this can really get. And that's exactly what I'm going to be chatting about today, is what is the things that you need to have in place in order to be part of that 30%, so that you're not part of the 2/3 that kind of get dropped off in the mix. So that's what this talk is about, and that's what I'm going to be unpacking. One quick caveat, I am going to be talking about venture capital investing and some angel funding and the different types of investing around that. There are many other types of investments as well. You get debt capital, there's bank loans, there's various like more traditional business financing. That's not where we play, and that's not where my advice is coming from. So we're specifically looking at high growth, high scale businesses, and looking at sort of like the startups, the swing for the fences of what everyone's trying to be. But it's specifically addressing this issue of huge drop-off, and why don't most businesses go on to raise a Series A, and what do you need to have in place in order to increase the odds of doing that. So a little bit about me. I'm currently head of product at Founders Factory Africa. We're a venture builder, have a portfolio of about 57 companies, mostly in Africa. We are currently investing in about 22 businesses per year. And what's unique about our model is we invest cash, but also access to our studio. So a set of support from people like myself in product and growth and engineering, partnerships, talent, and investments that actually work alongside our startups. So we give funding and support. And so this advice that I'm giving from is very much what we see and what I see on a day-to-day basis by working alongside our investments team, looking at what do startups actually need to get right? What do they need to get in place in order to actually increase their valuation and increase their odds of raising further funding? And so that's kind of the context of where I'm coming from. I've been a founder myself before. I've written some books on startups and validation processes and worked with a number of different accelerator programs. In total, I've helped build about 70 different early stage startup products across the last sort of 12, 13 years, and worked with hundreds of entrepreneurs beyond that. I'm based in Cape Town, so it's very rainy and cold, which is why with the windows closed and miserable. But we do spend quite a lot of time, and all the startups that we work with currently are almost all of them are Kenya, Nigeria, or South Africa based. There's obviously a smattering around that as well, but probably 70% of the businesses that we're currently working with are in those markets. So the advice and where I'm coming from is very much what's happening on the ground. It's very Africa focused. This is not a European worldview or European centric thing. So yeah, like I said, I'm relatively flexible with this. I'm going to run through a bunch of talks and the things that I see and I have seen through my experience of what people get wrong and what people need to get right. I am wearing a hat of investor, but also I'm being in the trenches with founders. So knowing what actually matters in the startups teams. Cool. But before that, enough about me. Let's dive in. And really, what you're looking at is like fundraising is hard. It's always hard, and it should be. There's a lot of reasons of why that is. It's never easy to raise a ton of funding at a very high valuation unless you have a bunch of things going in your favor. So the other thing is every investor has a slightly different mandate, a slightly different a thing that they look for. They have different opinions on what works and what doesn't work. They all have their own thesis and on what good looks like and where the opportunities lie in the market or where they're going to get the maximum return. And so just a cautionary tale that I'm not here to tell you how you're going to be able to raise funding from any investor. Every investor has its nuance, and you do have to do your homework when you're actually applying to someone. And so there will always be a certain level of customization. But having said that, there are some things that are due to the structure of how venture capital works and how investors think. And those fundamentals are the things that I'm going to be unpacking, those constraints, and then the fundamentals you need to have in order to address that. And so the biggest disconnect comes in from this investor misalignment. And it often happens, it's either on the investor side, it could be their mandate is wrong, they're only looking for certain businesses at a certain stage, or they're only looking for female founders, or they're looking for certain regions or certain countries where they believe there's there's untapped value. It could be a portfolio clash. So you're also, when you're applying to an investor, they're evaluating you against the rest of their portfolio and seeing if there's a conflict of interest or if there's synergies or how that fits. And a lot of the times investors have just been burnt by certain business models, by agent banking or by something that they just won't invest in that, even if it's not in their mandate. So there's plenty of reasons for an investor why you just might not be a good fit. There's a lot of reasons that aren't on the investor, though, that are also on you. And there's certain things that you might be working in the wrong sector, or you might have the wrong valuation. You might be trying to raise too much funding too early or too little funding too late, and it just doesn't sit right with how the numbers work for them. You could also be too early or too late for this particular investor, because every investor will typically invest in seed or pre-seed, or they'll have a stage or a range of where they like to invest. And so this advice is going to be quite generic, but it's looking at structural things around the nature of venture capital and how they think about it, and then the structural things that will always be true of what startups need to get in place or businesses need to get in place in order to maximize their chance of raising their funding. And there is no silver bullet. There's no a single thing that you can do or single focus that's going to get you there. But as I have mentioned, there are structural conditions, and in summary, what investors are evaluating on is going to be these four things. And so the first one is balancing risk and return. So they're balancing how much money am I putting in and how much return do I need to make out in order to justify this investment. Is it too risky? Is it not? Am I going to get the right kind of multiples? Does it have the potential to actually make the equation make sense for me as an investor? Like, for the risk that I'm taking, does the returns actually balance that? Or would I be better off putting my money in something slightly more conservative? And this often comes from the limited partners, the people who invest in the venture capital funds. They are evaluating, do they put their money in a stock market or in a bonds or in something else that's super low risk but lower return, versus investing through venture capital firms, which are much higher risk, but therefore they expect a much higher return. So there's a balance there that you need to be in the sweet spot of, and I'll run an example of this a little bit later. The second thing they're looking at you on is if the numbers kind of make sense and the risk and return balance makes sense, there's going to be a set of assumptions that are baked into your plan in order for you to be able to get that return. So if they're needing you to exit at a $100 million valuation, there's certain things that need to be true in order for that to actually happen. And the probability of those things actually happening is a huge factor of what they consider. Is the market actually big enough? Are people really willing to pay are artisans in Nigeria willing to pay $1,000 a month or $100 a month for this particular service? And then are enough of them, realistically, are we going to get 20% of the market? How many is that? How many do we actually need from that? So there's a certain equation of, for us to be able to be a $100 million business, we need to have a certain annual rate of return, ARR or MRR, monthly rate of return, of revenue that you need to be making in order to be able to justify that valuation. And so if you need to be making $100,000 a month, are there, if your product is $1 a month, the probability, what is the probability of you getting to 100,000 users? Like, what is the probability behind the assumptions of you getting to that number? If your product is $1,000 a month, it's like, what is the probability of actually reaching the market size that you need for that? And so beyond the risk and return, there's an equation and there's some assumptions that go into balancing whether that is feasible or not. And the probability of each of those things is something that investors are going to weigh. And the third point is what you can do to kind of lead into that, which is what evidence have you got so far of your current track record that will show that those assumptions that go into the probability are realistic. And so the more evidence you can have to show that you can reach this many users, this is your rate of growth, these are the things that you can prove in order to justify these assumptions, that these assumptions seem realistic and believable, that it becomes, and if those assumptions are realistic, you can get that risk and return. That's the thought process that the investor is going to go down. The first one is, though these rough terms kind of make sense, what needs to be true, or what can kill, what are the risks, the unknown risks that we need to mitigate, or the probability of us actually getting to that size outcome that we need? And then what evidence have we got today, or what evidence is there in the market, in market research, or in the actual traction so far of the business in order to actually justify the probability and remove the uncertainty in those assumptions? And then the fourth point is a layer that they're always going to look at, which is focusing on timing. Why you? Why now? What is the experience in the team? What is the what are the trends or the tech trends? If this is an AI type startup, are we riding that wave? Or what is there an opportunity that's opened up now with regulation or open banking that's making this possible where it wasn't possible before? You'll notice I haven't highlighted teams specifically because a lot of that is baked into probability of evidence. If you have a really strong team, they're more likely to assume, or very experienced team, the assumptions that you're going to bake in to the model in order to get those returns are going to be a lot more believable, and the credibility gets baked in as the evidence of that. So looking at it from these four aspects, like whenever you talk to an investor, these are the things that you need to have in place when you need to do that. And that's how the investor is going to be evaluating what your business is, or whether this investment at these terms, at this risk return model is going to make sense. And one thing to sort of note at this point that a lot of people get wrong is raising too much money too early. And the biggest problem with it is there's a huge mismatch around when you're trying to raise too much, the risk return equation is well out. The probability of you getting there is quite big assumptions baked into it, and you have very little evidence early on. So raising smaller money, less money earlier on at a lower valuation requires less evidence because you can do it more on the potential. They bias more towards the later stages in what you're looking at. But going to that first point around balancing risk and return, this is a whole nother talk on VC return models, and so I'm not going to get too technical in this, but I'm always surprised at how few entrepreneurs understand the core mechanics behind how a venture capitalist thinks about portfolio returns and thinks about what that looks like. And so I'm going to run a quick example where let's take a venture capital firm that have $10 million. They're going to make 10 investments of $1 million each, just to make the numbers easy. So for that, a typical VC firm needs to be able to show at least 5x return. That's kind of what their limited partners are putting in, because they can get reliable over a 7 to 10 year time period. They can probably get a 3 or 4x return through stocks or equities or bonds. They can start building that because of the way it compounds. But with a more risky asset, they need to be able to get at least 5x return. That's kind of the minimum threshold of what that looks like. So this VC firm that has $10 million needs to be able to make $50 million back for its limited partners. And so if that's the goal of what they're trying to do, typically what they make with the investments, they'll pick 10 businesses, give them each $1 million. And the first thing that happens is the 4 black ones at the bottom. Those are the ones that are complete write-off. There's a really high failure rate in startups for a whole host of reasons. Founder fallout, market not ready, not delivering the right things. So typically across a VC's portfolio, about 40% of that portfolio is just going to be a flat out, like a write-off, and they'll lose all the money on it. Not everything is a complete loss, though. And so the next gray ones are looking at where there's some kind of return. You might make your money back. You might do an acqui-hire or sell the IP to somebody else, or do a down round where you get quite heavily diluted out. So you never quite make your returns back. So it's a little bit of losses, but it sort of comes a bit out in the wash. And the last, the two at the top, the 2 white ones, those are where you make some return. So you might make a 2x or 3x of your money back. So they make $2-3 million, maybe $5 million back into the fund. But even if you make $5 million of both of these investments at the top, that's only really covering the other $7 million that you've lost, or the $9 million that you've invested in those other 9 in the portfolio. So even with those 2 that have 3x or 5x the money and made money back for the fund, they're still just kind of breaking even. They're still only sitting on $10 million or less of actual returns, which means that this 10% at the top, this yellow one, needs to actually return $40 million into the fund in order for them to meet the minimum threshold. So the trick with VCs is they're always playing this game where they only invest in businesses that they think can be this yellow one at the top. They need to try and gamble to, if they can get 2 of these yellow ones, they can return 80 million instead of 50 million into their fund. So it's completely disproportionate to the fringes, to the edge cases that end up making a return for the entire portfolio. And so whenever a VC is looking at a business, a traditional business investor might be looking, 3-5x return, that looks pretty good, but they're making much more conservative bets, and they're trying to get that, they're going to have a lot less failure rate. But the way venture capitalists look at it is they're typically looking at a much higher risk type investment. So the failure rates and return rates are a lot lower, a lot more skewed to the winners. So when they're evaluating your business, the balancing of risk and return, they need to be getting, like for $1 million, they need to be able to get $40 to $50 million back. So you need to be able to show how in 5 or 7 years, you can make this investor 50 to 100x its money. Like that's where those numbers come from. They're really not that unrealistic when you look at the constraints of what a venture capital firm is sitting under, and the returns they need to make to their limited partners who've actually given them the funding in the first place. So those are the constraints. So when you go in pitching, you're going to be 5x or 10x the business. The risk return model just doesn't make sense for the investor, and you're not going to even make it through the first step. So that's kind of the clause when you're thinking about that, and we can definitely go down this rabbit hole if there's questions. There's a lot more to that. But what you notice on the startups and from that early startup graph is the reason there's a lot of investments is because it's all about potential. It's taking a gamble, a small gamble of the smaller investment amounts at the earlier stages. And like, this could be something, let's put in a bit of money and see where it goes. It's incredibly high risk. But as you start getting to Series A and beyond, it's all about building real fundamentals, because you need more and more evidence because you're raising a lot more funding. The risk return needs to operate differently. And so you need a lot more evidence of what that looks like. And so the earlier you start building those fundamentals into your business, the higher the probability is you're going to have worked them out and actually you significantly increase your chance of raising funding further on. And early stage investors love those fundamentals just as much. They just don't require them. But a business that is a bit of like a promise and a gamble on a great founder versus one that's already showing that they can actually move these numbers and that their projections are much more realistic and grounded in real evidence of numbers and returns is going to just naturally attract a lot more funding. So I'm going to pause there. Any questions? Jump in with a chat or into the Q&A, or raise your hand if you do.
Yeah, please, if you have questions, please do well to like drop your questions for Roger using the Q&A, or you could just use the chat box or try to raise your hand and maybe I'll allow you to speak. Right. So let's just do that for a few minutes while before you continue to the next segment of the discussion.
Cool. Yeah, I've got this. I'm going to be unpacking quite a lot more around fundamentals, but I know that's been a meaty part. So I thought, let me just pause to see if there's anything.
Yeah.
Cool.
Do we have questions?
Any questions or thoughts from anyone? No? Clear as mud. There's one answered question. I'm assuming that's not for me. Yes, the talk is recorded. Okay, so what do we mean by these fundamentals? What does a good fundamentals actually look like for a business, and how do you build it? And so this is really where I spend most of my time working with our founders, trying to lay the foundations to help them work this out. And really at the highest level, what you're looking for is evidence for these four things. You're looking for evidence that people want what you're doing, that they actually have a problem, that you're solving a real problem. You're then looking for evidence that, yes, there's a problem and people want it, that if we build a solution, they'll actually use it. So what evidence do we have that people will use it? And if people will use your solution, can we get evidence that they will pay for the solution? And then once we can get some kind of people paying for the solution, the question then becomes, will they pay enough at scale, or will enough people pay at scale, or will the amount that they pay be enough? So you start looking at the mechanics of like, how does this actually project? But what we find is people often go into business modeling and you're mapping out that final step, but you actually have no evidence of whether people actually want it in the first place. And if people don't want it, it doesn't matter whether they'll use it or whether they'll pay it, because they don't want it. It's a guaranteed no. So without being able to show evidence that they want it, it means that they're not going to use it, means they're not going to pay. It doesn't matter how good your business modeling or your planning around paying is, if you can't show evidence that they want it or that they use it. So typically when we start with this, we start with, in the design thinking world, this is a little off center, but we start with desirability, then we move on to feasibility, and then we move on to viability. And so you're looking at what is the desirability of what we're building, and what evidence do we have that this will be desirable. Then looking at what evidence do we have that people will use it, and then evidence that that this is viable. And so when you look at the things you want to start tracking and the things you want to start building early on in a startup, is everything becomes a proxy for sales. It's a proxy for that last point. So showing that people want it, showing that there's demand, or showing that there's a wait list, showing that there's things is an indicator that yes, people will want it. Therefore, the assumptions are they'll use it, they will pay, and they will be able to build a business out of this. If you can show that people will use it, you're showing that we can build it, people will use it, it's adding value into their lives, they keep coming back. You're kind of implying that if it's valuable, people will pay for it, we'll be able to make a business out of this. And so in the early stages of a startup, what you're really looking for is to find really strong signals of desirability, and then building that into feasibility, and then fleshing out the business into desirability. And so often when people look at like, what are we aiming for with startups, or what does that North Star look like, or what do we need to have in place before we can raise that Series A funding? And there's this holy grail, the light at the top of the mountain, called product market fit, of what that looks like and where that fits in. And it's normally defined in such a vague, open-ended manner, where it's, if you have to ask, you don't have it, or you can do an NPS score and see how likely people are to recommend it. But those are all such open-ended, untangible, very vague measures of that doesn't actually help you build a better business. It doesn't help you define where you should be focusing in order to build strong fundamentals. And so what we typically look at is, first, build something that a few people love. So build something people love, as Paul Graham famously quotes. And it's around, how do you get a small number of people to love what you're doing? How do you deliver intense value to a small number of people that we can get repeat usage out of them? They keep coming back to the product. They absolutely love it. And once you can get that right, you then focus onto how do we attract more people like that. See, the numbering's got a little weird in this deck, but how do you find more people like that? So once you've got engagement, you then focus on how do we find more people like those ones that love us. Because most of the time, when startups launch, they're often just spraying and praying and trying to get tons of users into their funnel, but there's no real activity, there's no real action that happens on their site. And so all of those people coming into their funnel are just leaking out, and they're not actually being able to capture any value of it. So by focusing on engagement first, you end up focusing more on what is actually sticky about this, and you can make changes and iterate with tight feedback loops with a small number of passionate customers, and use that to start building evidence and structures and systems on how you can bring more people into the funnel, and focusing on that. And then lastly, once you can attract people into the funnel, you're looking at how do we optimize so that they're not dropping off, so that they don't churn, or how do we do upsells to increase lifetime value, or increase monetization per user of what that looks like. So we start with building something people love. We then move on to once we found those people, we've identified exactly who they are, we go find more people like that. And then we keep optimizing the mechanisms and the payments and the upsells and how we charge and billing and drop-off rates and things in order to get them up. So, and the measurements that we use for each of those are engagement, activation, acquisition, and retention. So I see a question here from David's is, can you enlighten more on desirability? Desirability is measured by engagement. Can you build something that people want to come back and they want to keep using it? Do they use it multiple times a day, multiple times a week, multiple times a month, depending on B2B products, as the cadence is generally slower. But if you have a highly engaged audience, it shows that there's a strong desirability with a particular user segment. And it's far easier to go and find more users like that than it is to have 100 different types of users or 10 different types of users using your product, but no one really engages much, and they use it once and drop off, and it's kind of a second or third rate product, but you're not really standing out. So by focusing on desirability, what you're really optimizing for is engagement. How do you increase engagement rates? How do you get a user who's used your product once to keep using it, to come back? Like, what is it that they're looking that they love about the product, and how do you amplify that? And so that's kind of what you need to look at is the metric to optimize for early on is high engagement rates. Forget about the 100,000 users you need to get to. If you can get people incredibly engaged, that's what's going to make the numbers. A lot of businesses like Facebook had the add 4 friends or add 5 friends within, or 3 friends within 5 days, or whatever. They all have those kind of engagement. All of those key mechanics of whether it's working or not are driven primarily around engagement. And so that's the thing you need to get right first. It doesn't help to bring 100,000 people in if they're just going to drop off or not really going to be engaged, or they're going to forget about the product because it doesn't really add value. But if you focus on value creation, that's all around engagement. And once you're really clear on how you deliver value and how people are repeatedly engaging with your product, you can then focus on how do we find more people, how do we bring more people like those into the products, how do we launch other value systems for different customer segments based around that core thing. And once you've got that right, you then look at, okay, how do we keep people around? How do we focus on optimizing retention rates, minimizing churn, maximizing lifetime value, that sort of thing. And so those are the things you need to, that's kind of the order in which you need to look at it. And if you look at it, it's the sort of desirability, feasibility, and viability that you need to focus on. And so only once you have those 3 things in place, do you have really strong fundamentals, that you understand the core mechanics of how your business is working and what you need in order to raise the funding. And so if we look back at this holy grail of product market fit, the best measure that we've come across or that we work with around how to define product market fit is towards these 3 things: the engagement, activation, and retention. Acquisition and retention are the waypoints up the mountain. They are the way in which you get to delight. And once you're tweaking retention and you've got a really great engine that's just churning out revenue and churning in users with a lot of people, that's when you're at the point when you're ready to start raising Series A funding and beyond. And the big difference that we see between companies that have raised a lot of hype and conjecture press and those sort of things, versus the ones that have actually built real fundamentals, that have built the real mechanics of what makes their business tick and how their business works, are the ones those are the ones that go on to raise follow-on funding and actually build successful businesses, and the ones that run out of hype relatively quickly. So the big question comes to, like, how do you focus these things? And so the last point I'm going to touch on is just a couple of habits on how you and your team can change the way of doing things in order to get that. And so often when you need to focus on engagement, it's less about focusing on a particular product or a particular thing. And so when you're thinking about what you need to deliver as a thing, it becomes a limiting factor where everything, yes, I'll explain a Series A and Series B funding at the end, but it becomes a limiting factor of what you need to ship. Whereas if you focus on the way that your team communicates, collaborates, and makes decisions, you're going to build a team that is focused on the right metrics, and you're going to keep experimenting and optimizing to find high engagement rates or find the best acquisition. Because it's the difference between theory and practice is, in theory, they're the same thing, and in practice, they're not. And so it's really important to be less worried about the thing that you're shipping and more worried about how your team is learning and evolving the product, and how you're taking feedback, how you're engaging with stakeholders, how you create those tight customer feedback loops in order to actually connect with building the right thing and building the right habits on how to actually build many great things, not just one, because invariably a product is always going to evolve as you learn new things. And if you're trying to build a single product, you're probably not going to evolve with your market, and you're going to really struggle to identify the unknown unknowns and the learnings that you don't have. And so the top 4 habits that I've found that are the more sort of practical on how to build a team that is effective in the way of delivering value is the first thing is to think small and ship fast. Too many times people are like, oh, we just need to build this whole mobile app and then customers will love us. But normally there's a whole bunch of value propositions in there. And when you ship it, it's very messy to get feedback. And so one of the really clear indicator of great teams is they can identify a small piece of value they need to deliver, and they ship a small piece, deliver it, see whether it's measure whether it's delivering that value or not, and then iterate and try and ship something different, or try and ship an improvement on that. Or they're finished with that item and they move on to the next item. But a high shipping cadence of iterating and making lots of small changes is a really good indicator that you're focusing on the way the team delivers value, and you're not getting lost in trying to build this perfect solution that's in your head that isn't actually relevant for your customers. Then the next point is baked into that, which is your sort of tight learning loops with customer feedback. And one of the problems of having a slow shipping cadence is the feedback loops of whether you're on the right track or whether you're working or not is really, really weak. That evidence that you're learning and adjusting, it just isn't really there, because it only happens every 3 or 6 months when you actually deliver something new to customers. Whereas when you're shipping every week, you're getting a lot of evidence of little things that you can try, that you're constantly seeing customer numbers and engagement rates or acquisition rates jumping up. So creating those tight feedback loops and lots of interactions with customers is really, really cool. The fourth point is sort of a slightly controversial one from my part. So everyone talks about being data-driven, and it's really good to be data-driven, but it's very difficult to be led by the data. There's that saying of, if you give me enough data, I can make the graph tell any story you like. And normally data can be quite easily manipulated, especially large amounts of data. And so normally what I've found, especially in early stage startups where there's so much uncertainty, is if you're close to your customers and you're getting lots of great feedback loops, your team often has an instinct of what's right. It's risky to just build that straight off instinct. But if you have a very clear instinct of, I think this is what the problem needs to be, it's normally really easy to test, or it's really easy to find the data to either validate or invalidate that. And so I generally coach teams on trying to be instinct informed and data validated, not just purely led by the data. There is a human element that comes into this, specifically in the early stages with loads of uncertainty. And then the fourth thing is to not scale until it's really working. And this kind of ties back into the funding that you raise. If you try and raise too much funding, or if you try and bring in too many users, the signals get very messy, and it becomes very difficult to actually work out the core mechanics of how your business works, how you make money, and the unique insights that you have of why this is going to be a $100 million business. And so staying lean, and I'll get to lean now, but staying small and focusing on engagement before acquisition really helps you to make sure you deeply understand what you're doing, and the signals and the feedback you get is much more precise and much more clear. And when once you really understand that well, and you can do it in a highly repeatable way and have high engagement, you can then start looking at acquisition and increasing scale and expanding beyond that. And there's a big misunderstanding around lean and the lean startup. A lot of people think that lean means spending less money, but that's not actually at all what the lean startup is about. The lean startup is around the rate of learning. So how do you learn faster? And early on, normally spending lots of money early on actually slows down your learning, because you're trying to run too big experiments and the feedback loop is too slow. You can't get through that build, measure, learn loop fast enough. And so in the beginning, it actually does it almost always correlates to just spending less money, shipping faster, learning faster. But you get to a point in a startup when to learn faster, you need to actually start spending some money. And then you're no longer optimizing for less money, you're optimizing for a faster cycle time of how do we learn faster? And you get to a point when you actually just spend money in order to do that. But it's important not to be ramping up that money until you can learn the fundamentals and get the basics right before you expand. So in summary, is to increase your odds when you're fundraising is to build a business with strong fundamentals. It's build a business where you deeply understand the core mechanics that make it work. And specifically to that, it's the metrics that get you towards product market fit of engagement, acquisition, and retention in that order of how you do it. And then once you've got that right, make sure that you're a match for the investor that you're actually applying for. Make sure that the information, that the way you're pitching, the stage you're pitching, the mandate fit is a fit for the right thing. And if you get those things right, you're going to significantly increase your chance of raising further rounds of funding as you move on. And that's me. So I'll jump to some of the questions now.
Yeah.
I see there's already some in the mix there.
We have like 4 questions in the QA box with so much explanation. So I think you can start with David Chijioke.
Cool.
Can you? Yeah,
David's one, I think I answered that already. Can you enlighten more on desirability and how to achieve proof of desirability? So proof of desirability for me comes around engagement. So how are you showing evidence of engagement? How often are people coming in? If it's a consumer product, they should be coming in at least once a week, if not multiple times a week, during a period of activation. If they're looking for a house, are they actually logging in every day? What does that engagement look like? How do you increase that engagement? Then going on to Levis's question is, on my website, we have more users coming to consume content rather than add content. Is that a bad element for a startup? And it's like, not at all. If people coming to consume content is tied to how you make money or how you're going to grow the business, that makes a lot of sense. That the more people that come in, so there's plenty of publishing platforms like Medium or Substack or things that the more people that view it, generally the more revenue it makes. There's a direct correlation to exposure of people consuming the content to the revenue that it makes. All ad models run in the same way. And so they're purely just optimizing for people coming to get the content. Optimizing for engagement is an indicator that you will be able to monetize further down the line. I think the extreme example of this is something like WhatsApp that sold for $1.9 billion with 0 revenue and only 40 developers, or for a team of 40 people. And in hindsight, that was a complete bargain. It was a complete steal because they had such a high engagement rate. They were growing at 10 million users a month. And those users were actively using it and engaging on the platform, and their engagement, activation, and retention numbers were through the roof to such an extreme amount that revenue didn't matter. Like 10 years later, or 8 years later, whatever it is, whenever they were acquired, like they're only starting to turn on business, WhatsApp for Business now, and turning on some different premium features, but they were growing at such a massive rate that didn't actually matter because there was so much evidence to show that this would be huge that you can work out how to make money later. For most of us, that's not the case, and we're never going to grow that at such a rapid rate. That's like literally 1 in a billion. But the principle still applies. So if you have lower engagement rates or lower activation rates, you need to be able to show evidence of revenue a lot sooner. If you can show a lot of engagement, a lot of activation, and a good understanding of retention, then you're going to need, the focus will shift off the need to be able to show evidence of revenue a lot in the earlier stages. So can you explain what the Series A or Series B funding works? So it's really just stages of funding. So your typical rounds of funding for a venture backable startup, you're looking at normally some kind of grant funding or accelerators or incubators, or what we call the friends, family, and fools money. It's money that you can pull from your network that are typically just investing in you because it's you. And a lot of the early stage funding is just around, hey, this is an interesting idea. Let's put a little bit of money behind it and see if we can validate that this might actually solve a real problem. So there you're very much focused around the customer's problem. The next stage of funding you're looking at is normally what we call a seed round. And there's quite a wide band of seed funding. It could be anything from $25,000 to $500,000, or some people raise $1 million or $2 million in seed rounds. So it's quite a wide range. But it's typically once you've proven what the business needs to look like, and there are pre-seed and seed rounds, and there's a couple of different ones in the middle. But as you move into the later stage, into around a seed round, you're then expected to have, you understand the problem really well, you're delivering that to users, so you've got the high engagement, but you're now raising funding in order to increase acquisition and show user growth. And so you want to show user growth and then focus on retention and optimization of the business tweaks to prepare you for a Series A funding. And the Series A funding is really where the rubber hits the road. Typical Series A rounds in South Africa is anything between, I'd say the lower end is probably $5 million up to about, it could be anything up to about $15 to $20 million of what they would look like. The Brighter Bridges report that I mentioned in the beginning, they've got all that data in there. I'm not sure of it all offhand, but typically what they're looking for is, like, you've got the core mechanics working, you're now ready to scale to either dominate your existing market or expand. In Africa, it's quite often to expand to regions or nearby regions. So if you're in Nigeria, it'll be funding expansion to Ghana and maybe Francophone or other parts of West Africa. If you're in Nairobi or Uganda, it might be expanding to Tanzania or Kenya. You're looking at expanding around that. In South Africa, it's normally to expand to one of the other hubs because the other regions around us aren't nearly as big. So you'll typically raise a Series A for expansion. So either dominate the current market you're in and just hire a bunch more people and start spending a lot more. Now that you've got all the mechanics working, you throw a ton of funding in to help you scale, or you're moving to, like, let's move to West Africa, or we're in West Africa, we're going to raise this funding in order to set up an office in East Africa and expand to that. Funding B, a Series B or Series C is really just more a level beyond that, of when you're really ready to take this to the next level, or maybe take it to Southeast Asia or South America or into Europe, or really sort of expanding beyond that. So at each inflection point in your business model or your business plan, you're normally going to need an injection of capital to overinvest in that, to accelerate an expansion or accelerate growth into a new market in a way that you're doing so only if your current revenues wouldn't allow. So if you're only doing it off profit that you're trying to bring in from your revenues, you're going to expand a lot slower. And there's certain risks to that. So by raising some funding, it allows you to expand faster than your current revenues allow. And so the more funding you raise at the later stages, it's just helping accelerate that and helping you do that at a way, way bigger scale than you can before. And then there's another question from Akeen. What are the measures to take during product ideation to ensure that the product has actual value to a market segment? And that's a great question. So super early on, you're looking at what is the evidence. So we want to first identify the different stakeholders around my problem space. So you want to identify a couple of parts around all the stakeholders around that. And you want to deeply understand each of those stakeholders. What are the jobs to be done, or what kind of value, what problems do they have, and what value are they trying to extract from this particular scenario. So if you're looking at healthcare, looking at offering a healthcare insurance, or let's pick a Uber for nurses. If that's what your stakeholders are, you have the nurses, you have the stay-at-home, the elderly care, you have diabetes or chronic care patients, you have maybe younger children wanting to provide the care for the elderly things. So there might be an insurance play, there might be hospitals or other stakeholders in that mix. So you want to deeply understand all of those customers. That normally means going out to do qualitative research to understand what is that they're trying to do in their day-to-day, what might this go wrong, how might this work, what are the real problems that they experience. So like with a child wanting to care for their gogo, their grandmother, parents in a different city. Often the children are either expats or in the city center, and their parents are back in the village back home, and they're not there to actually care for them, but they want to make sure they have the care. So there's a problem space that we can deeply understand. Let's chat to 5 or 10 different people to understand that there's a certain similarity in the types of problems. And once you get evidence of that through like validation from customers, yes, I have this problem. Yes, I have an elderly care. Yes, I worry about them. Yes, I'm currently sending money home. And the problem is I don't know where that money is going or where it's getting spent on. And so being able to think about that allows you to understand the problem. And then you can start saying, well, what kinds of solutions might this help? It's like, can we send a nurse to check on your mother or do a diagnostics? And maybe in the beginning, you pay for the nurse just to lower the barrier of price, to say, well, if it's free, will they use it? Will they actually call a nurse out to go and visit their mom? And then when you do that, what are the problems you run into in that space? So when do you get to a point where, like what is unexpected? Like maybe you can't find the address, or maybe the person's not there and they say they'll be there at a certain time and they're just never there. Like, how do you solve that problem? And so as you start getting evidence of trying to deliver the problem, you're going to learn things about what kind of system or what kind of solution or what the solution needs to be in order to do that. And so that's what we call sort of solution prototyping, of how might you deliver that. And it's normally you do like a concierge method, where you like software as a service. At the end of the day, it's still a service. So normally one of the easiest ways of doing an early prototype is to be what the software would do, to deliver the value to the customer, but do it manually instead of in an unscalable way. And so that you can actually just learn what all the processes are. And then once you're doing it, you document it so that you can give it to an intern or somebody else to deliver for you. And normally once you've documented it, that somebody with no knowledge can deliver it, you've probably created a good enough blueprint to actually now try and write this into code and to create a spec to actually build software around it, to turn it into software as a service. And so those are the early types of activities. You focus on validation around the customer problem, and then solution prototyping, of how do we find evidence of people actually using the solution, or us delivering the service in a way to justify, hey, if we automate it in this way, we build this technology, we can do this, what we're already doing, at a much higher scale. So that's the kind of evidence of that, and thinking about how you segment markets, or how you find maybe the chronic care, maybe there's a unique use case or problem that diabetes patients have, or elderly care, or what is the niche or the segment within this space that you might actually need to deliver a service to, or customize your service to. Does that answer your question? Any further questions? Akeem, is that yours was probably the most open-ended? Does that get what you were looking for? Are there any other questions?
Hi. Okay, yeah, someone just dropped one more. Christian Court. Oh, and Akim just said, thank you so much. You know, that shows that you answered this question. So let's take Christian Scott.
Okay, there's one from Christian. Is, what do you as an investor, mentor, product advisor look for when looking at startups that are standing between large instinct-informed and data-validated decisions that could radically influence the outcome of the startup? What should the founder focus on when having to motivate their opinion? So the great thing about really strongly held opinions is they're normally very easy to validate. So if you have a strong belief by something, it should be really easy to do something small or create a test to show whether that's happening or not, or show whether that's true. And so you're looking at, like, what is this, like, if we're really clear about the problem we're trying to solve, like, I know users have this problem. Great, let's go chat to 5 users and see if they actually say they have this problem, or ask them, what is the biggest problem they have, and see if they answer this. So what's the hardest part about trying to achieve this goal, and hope they state the problem that I've stated. So like the more specific you are, or the more opinionated or strongly held belief you have around what a problem is, the easier it is to test. The hardest things to test are vague, open-ended questions that aren't very clearly defined. But normally when somebody has a very strong opinion, it's really easy to validate or invalidate. It's like, great, that you think this is a massive problem. It should be really easy to find people who will say this, they have a problem, or will take an action to show that they want a solution to that problem. And so finding evidence of how do they, like what actions are they taking? Do they join a waitlist? Do they sign up to a website? Are they willing to pay you a pre-order to say, hey, I will pay you to solve this problem for me. And in fact, I'll pay you before I know how you're going to solve the problem, because it's that much of importance to me. Those are like really clear evidence that this is going to be a viable problem. So the more strongly held your opinion is as a founder, the easier it should be to show data, whether that is. And if you hold really strong opinions that are very difficult to validate, that's normally a bit of a red flag, because it shows that you're a little delusional. And there's a quote that I like, that all founders are a little bit delusional. And you have to be, as a founder, to imagine something that doesn't exist, that you see something that other people can't see. And that's kind of the definition of being a founder. But the way you don't get lost in that delusion, and the way you don't sort of like be the lemmings jump off the cliff, is to find data and to show the evidence that backs up that delusion. And so the more strongly held that delusion, the easier it should be to find the evidence to show that this is actually a huge trend that everyone else is missing. And if you can't do that, then there's normally a mismatch. Like you're probably leaning a bit more on the delusional side and a little less on the visionary side.
Yeah, he says, thank you so much for the answer. I found so much value in it.
Cool.
All right. Thank you so much, Roger. So far, this has been a super engaging discussion. We have 3 minutes to like wrap it up. Very amazing session. Maybe we could just take one more question and we'll call it a day. We just have 3 minutes here, and Roger shared everything practically, bro, that you could actually like input into your business. Oh, Roger, do you have final words for us before we like call it a day?
No real final words, other than you can find me at Roger Nort on Twitter or Medium. I write about this sort of stuff and I engage in it quite frequently. If you have questions or something comes up later, feel free to find me there and hit me up. Always happy to chat.
Oh, can we like get the handle in the chat box so that we could?
Sure, I'll drop it in here as well. I am at Roger Nort. On Twitter, LinkedIn, Medium, you can find me in all those places if you just search for that.
Okay. Please do well to like follow Roger. He's giving more practical tips. And yeah, it's Friday. Thank God it's Friday. Thank you so much for coming, Roger. Taking time out of a very busy schedule to like have this discussion with us. It's been amazing, true and true. Where can we request access to recording? Actually, it's usually uploaded. Oh, there's one more question. All right. 2 minutes to go. Roger, I don't know if you can take this one. Actually unrelated, but I wanted to ask if you get recording of the webinar. Yeah, sure. We are going to drop the recording of the webinar in the community, as well as via mail, and we'll definitely upload it to our YouTube channel. So just be on the watch out. You could see it on our YouTube channels. Also, Roger will be sending in his slides, so you could have the slide, go over it again, and refresh your memory of what has been said so far. All right, guys, thank you so much. It's like 1 minute to go time, and it's Friday. Friday. Yeah, bye, Roger. Thank you so much. Bye, everyone. Thank you for joining in. Yeah, and staying put to the end. This has been like an amazing discussion. Thank you, Roger, for coming. Thank you. Yeah. Thank you for this talk. Kristen is saying thank you. Please, can we get more thank yous from you all, the audience, attendees? Say thank you to Roger too. Yeah.
Thanks, Steve.
Yeah, thanks a lot.